I saw yesterday or last week a line from you saying it was, do I have this right, a generational buying opportunity, at least in financials?
Yeah, we really believe that. I mean, if we learn one thing in 2018, it's that change is going to be constant and volatility is going to reign supreme for the next couple of years. And through that, you really want to default to fundamentals and process, and also overlay, be a little contrarian, given the fact that we believe the majority of investors absolutely, positively hate financials and are driving the majority of their positions in terms of institutions based on fear and emotion. We believe that most institutions are dramatically underweight financials, and we remain overweight that sector, focusing on companies that have scalable business models like Bank of America, like Morgan Stanley, like Goldman Sachs, and some of the trust banks as well, just in terms of providing companies with service, given the fact that we believe our primary themes for financial services, Carl, for the next 3 to 5 years are commercial banking and wealth management. That's why we want to be in those names in particular. Speaking of contrarian, we're buying the dip in technology too. You've noticed how everybody just hates technology all of a sudden, and you yourselves are focused on more of the momentum names today with good reason, because they're taking them behind the woodshed here a little bit, which is pretty classic in terms of a pullback. But we really focus on those names that provide stable earnings. I think one thing that people are missing is over the last 15 years, Carl, the technology sector has actually become the most stable earner in terms of the standard deviation of earnings growth, meaning volatility in earnings growth has dropped dramatically in technology, and those would be the names that we would focus on, names like Apple, Microsoft, Oracle, those types of names.
Brian, what has to happen on a macro basis for a lot of this to come through, for people to go back and kind of lay more bets on financials, and then to have technology find its footing?
Well, I think it's a great question, Mike. I think at the end of the day, people have to come to fruition that we're going to start to see more business investment from a macro perspective. We did some analysis of where corporate CEOs are right now in terms of not only their longevity, but their age. Their longevity in the seat is at the highest level we've seen in multiple decades, number one. Number two, the age of a CEO in America and S&P 500 companies is plus 64. So what does that mean? The majority of CEOs, from a macro perspective, which was your question, were hired in 2009, 2008 for a very specific reason. They were hired to cut, and build balance sheets and build cash flow. We think the next stage of corporate CEOs and leadership in America will be more growthier CEOs that actually will implement the capital and grow, and we haven't even seen that yet. I think that's a major theme over the next 3 to 5 years from the macro perspective. Overall, macro conditions, the economy still 3%. Interest rates, low, meaning you can have a higher risk premium and a little bit higher multiple. We still think that 18, 19 times on an earnings basis is very affordable for the U.S., and stability of earnings and stability of business operations will actually see fund flows back to the United States, out of Europe and out of emerging markets.
Right, we got to go, but is there any part of the market where sentiment is weak and you think it's deserved?
I think you guys hit it on the head in terms of high yield, especially utilities and REITs. I think utilities have been areas that people have been hiding in, quite frankly, and then consumer staples as well. And those are all three areas that we would be very structurally and aggressive sellers.